Okay, I think we're ready to start. Rebecca, are we? Are we good to start? Okay. So thank you for joining us for this webinar event. We've put it on in co-hosting with Olivia from Capitalise, who we partner with, who are a funding platform, but they also provide additional services around business credit scores and tracking and support for our clients in that respect. The meeting is going to be recorded so that we can share it with people who haven't been able to join this session who requested it to be sent. So just to let you know about that. We're going to cover today managing your business credit score and how we can mitigate the risk to your cash flow and the full life cycle, and then the tools that we have available that will enable you to make your business more resilient, what we can offer, anything that there's a few different elements to it, which Olivia is our expert in this field. We've been working with her for the last year, so it's great to have her on the call. So we're going to kick off first with Olivia's going to do a high level overview of just the macroeconomic climate and what we're seeing at the moment.
Brilliant. Thank you, Jill. Hi, everyone. Thank you so much for inviting me on to co-host this webinar today. So as Jill said, I'm going to start with a bit of a high-level overview of the macroeconomic landscape and what we're seeing in terms of SME funding. So as I'm sure all of you are already aware, we're really in a volatile market at the moment with ongoing increases in interest rates over really the last 18 to 24 months. You might have seen the Bank of England base rate has just seen its 13th rate rise and is now at 5%. And what this means is that in terms of lending, lenders are changing their lending products. We're seeing that there is a constantly changing and evolving landscape in line with the economy. And I can give you lots of examples of what we're seeing at Capitalise, but one in particular that stood out to me that actually we saw last week was that a property finance lender got in touch with us, and there was currently 4 offers out on the table. And basically they asked the client to pay the valuation fees by the end of the day, the end of the Friday. Otherwise, those offers would be pulled, and as of the Monday, there would be new rates issued. You can really see how the lenders are responding to this change. But the reason for this is that the lenders have to have confidence that they're going to be repaid and that they're going to make money, in line with the changes in the economy. So a couple of stats that I thought would be worth mentioning is that 40% of businesses have less than 3 months cash runway. So if you think about it, if one invoice can't be paid, then this could lead to potential insolvencies. And we have seen on the whole in the last year, insolvencies are up 32%, and cash flow is proving to be an issue for many businesses. So that leads me on nicely to the second point, which is funding. So at Capitalise, we've definitely seen an increase in funding demand across SMEs. But probably more importantly, what's worth mentioning is that there's been a 45% increase in the number of businesses that come to us saying that they need the funding right now. And this is because, as you're all aware, funding is a timing piece. It's usually triggered by some form of event, whether it's a bill that needs to be paid, a van that needs to be purchased, but it's also emotional. It's for your business. It's something that you're looking to do to grow and achieve your goals. But often, because of that emotional pull and element, what we typically see is across the SME lending landscape, businesses do leave little time to source the funding that they need. But actually, by partnering with your accountant, you're 4 times more likely to get the funding that you require and the best lender match and the best product as well. So something that's worth thinking about when you're looking for funding is weighing up the cost of borrowing with actually what you're going to gain as a result, whether that's increased profitability and growth for your business. So sometimes actually when the best time to look for funding is when you don't think you actually need it, so that you're setting yourself up for success in achieving those goals. So as Jill mentioned, funding really ties in with credit scores, and the focus of the webinar today is we will talk quite a bit about credit scores and the importance that they have for your business. As you can see here, so on the whole, credit scores are decreasing. They've decreased 9% on average in the last year. But what's interesting is that the minimum benchmark credit score, so the minimum score that you need to be able to access funding, is increasing. So that credit hurdle is rising. And a really important stat is that only 29% of businesses actually know what their business credit score is. Maybe on the personal credit score side, they're familiar, but when it comes to the business credit score, it's typically an area that businesses don't know too much about. So what we've seen is that actually those businesses that proactively track and monitor their credit score and the credit scores of the businesses that they work with are actually 6 times more likely to be in the A credit banding. And we'll talk about the benefits and the advantages that you get for being in that A banding as we go through. And then finally, in terms of debt, so on average, 80% of invoices are paid late, so a really large proportion, which in turn leads to cash flow problems. And in fact, 56.4 million hours are actually lost chasing late payments or bad debts. So if you think about where that time could be better spent, it's really important to actually, be aware of these things. And 61% of businesses are not actually aware of or tracking where they're spending their money. So there's lots that you can do, in partnership with your accountant here, in changing this narrative. So moving on a little bit more into credit scores and their importance. So they are really instrumental in accessing credit for small businesses. So if you look at the graph here, most businesses, unless they've been trading for 5 years or longer, sit outside of the typical lending zone. So really, there's a really big difference in the funding that you can access based off the credit score that you have. So the higher the credit score, the cheaper borrowing you can access. The lower the credit score, the more expensive the borrowing. To give you an example, we actually saw recently there were 2 businesses that were looking for the exact same funding requirement. It was 250k over a 5-year term. One had an A credit score and one had a D credit score. The A credit score client got offered an 8% interest per annum, and the D credit score client got offered 18%. And the actual difference in interest, so the savings for the A credit client, was £80,000. So it really is huge in terms of the borrowing that you can access, but also supplier credit as well. It can help with your negotiating power with your supplier limit and that free working capital that you can access. And just to show you what this looks like, so typically you'll have a score between 0 and 100, and the lending zone, so that minimum benchmark that I mentioned that lenders typically will need to see for you to get the funding that you need, is around 51. And 90% of the lending that we facilitate at Capitalise is between the A and the C credit banding, so from 51 to 100. It's not to say that below 50 you won't be able to access funding, because it does depend on the sort of product that you're looking for. But typically the rates that you will be accessing will be a lot higher. So it will be a lot more expensive for you to borrow, or you could actually get declined for funding at that stage as well. So the higher the credit score, the cheaper the borrowing that you can access as well.
Thanks, Olivia. So we've prepped some questions just to run through and guide us through the different areas of business credit scores. So the first one, Olivia, just a general question: what is a business credit score?
Yeah, sure. So putting it simply, a business credit score is really a measure of a company's credit worthiness and their financial health. And it's used by lenders, suppliers, procurement companies to really assess the risk of doing business with a particular company. So business credit scores are calculated by computer-generated algorithms by different credit bureaus. So you might be familiar with some names like Experian, CreditSafe, Dun & Bradstreet, Equifax, to name a few. But for the purpose of this webinar, what we'll focus on is Experian credit scores, as Experian hold the majority market share. It's what over 90% of lenders use as part of their underwriting, and the largest suppliers too. So a credit score is calculated a score between 0 and 100, 0 obviously being the worst, 100 being the best, and bandings from G to A, G being the worst and A being the best.
Okay. And what factors will impact on a business's credit score?
Yeah, good question. So there's lots of factors that impact a credit score. We could do a whole webinar just on all of those factors, but just to name sort of a few key factors. So first of all, payment trend is really important. So timely payment on trade credit accounts and loans, for example, will have a positive impact on your credit score, while late or missed payments or worsening payment patterns compared to the industry average and the industry that you're operating can have a negative impact on a credit score. So definitely something to bear in mind. Also public records. So for example, if you have a CCJ, county court judgment registered against your business, that can significantly impact your credit score, especially if it's not satisfied within 30 days, because it will stay on your record for up to 6 years. So really important that if you do have a CCJ, that you satisfy that within those first 30 days. Another factor is actually the age of the business. So typically credit bureaus like Experian will view younger businesses as higher risk, whereas more established businesses are considered to be lower risk. And also the industry that you operate in as well. So some industries are perceived to be higher risk. To give you an example, during the pandemic, hospitality businesses were all painted with the same brush, and that credit score in that industry was downgraded. Luckily, there are things that you can do to boost your credit score, which we'll talk about throughout the webinar. But it just goes to show that sometimes just the sector that you're in can have an impact as well. Another thing is directors' experience and the number of directors. So to give you an example, an above average number of directors and a steady rate of new appointed directors actually indicates healthy growth in the business. Whereas a limited experience by a sole director or a new director can be deemed quite risky. Another thing is the gearing ratio. So if you've got more debt than equity in the business, and if you've got higher liabilities than assets, these are sort of things on your annual accounts that will feed into the credit score as well. But that's just some of the factors. As I said, there are lots of different things, but it's worth just bearing those in mind because they will either have a positive, a negative, or a neutral impact on your score.
Thanks. And why is a healthy credit score so important to a business? It's not just for going out for funding, is it? There's other reasons to look after it.
Yeah, so I'd say, there's probably 3 key reasons. As you touched on, definitely lending is a key one of those, because as we've touched on, the credit hurdle that they have to meet or exceed before even being offered a facility is something that a credit score will determine. But also larger suppliers will rely on credit scores and suggested credit limits to dictate what interest-free credit terms they'll actually offer a company. So the better the credit score, actually a business can access free working capital, and maybe as a result, they don't actually need to borrow. But also another aspect as well is potential customers, joint venture partners, grant-making bodies. They may use a company's credit score to actually assess how resilient a business appears, because what the credit score is really the probability that a company will continue to be trading without insolvency. So that's why they will look at that score when looking at all of these things. So I guess in summary, it helps access cheaper borrowing, gives businesses better negotiating power with suppliers, and puts them in a stronger position when tendering for new work. It could really be the difference in winning or losing a major contract, which will change how a business operates.
Yeah, and I think that's an important point about the suppliers. Using it to set a credit limit, because you may, if you get a higher credit limit, you may not actually need to access any lending. And obviously that's a much cheaper way of funding your business and gaining some cash flow.
Exactly.
Why be so proactive in monitoring it when you're in business? Why do you need to be constantly kind of monitoring and looking after that?
Yeah, so I guess proactivity is really key when it comes to credit scores, and it's also a key aspect of financial management as well. It's going to empower a business owner to protect their credit reputation, make more informed financial decisions for the business, and ultimately position themselves for growth and success in the long term. I'm going to use funding as an example, but let's say that you want to grow your business over the next year, and maybe the funding need isn't imminent, but say in the next 12 months, you will require some funding. it's super important to be proactive because some lenders will take a 6 to 12 month average of your credit score. So it's not actually what it is at present, it is that accumulative score. So if you're not proactive, you could still be declined for business funding, even if your credit score is really good at the moment. But also, businesses who actually are checking their credit scores are 4 times more likely to get affordable finance. So it really is key to be proactive and just stay on top of these things. And there are lots of ways that you can do this and tools available to support and make your life easier around being proactive as well.
Yeah, so it's really important to be thinking ahead, isn't it? So the 6 month average credit score that lenders are looking at is, you can't foresee when you want lending, but being proactive enables you to have a resilient credit score and make sure that you're in the best position.
Yeah, and it feels strange to be so proactive and forward looking, especially 6-12 months ahead, but really it will lead to lots of advantages for the business. So it's worthwhile thinking about it, from the outset of conversations.
Yeah. So your tool that you have, Capitalise for Business, helps businesses keep on top of this credit score. Can you just talk us through how that works?
Yeah, of course. I tell you what, I'll actually just pull it up on screens so you can all see what this looks like rather than me talk it through and it not make sense. So I've just got a demo data here. So basically what Capitalise for Business actually is it's a full suite of Experian credit tools broken down into 4 key areas. So really the first thing is, as you can see on my screen here, it's tracking and monitoring your own credit profile. But what this actually is it's your consented Experian credit score. And this is the exact score that banks and lenders will see. And you can also see here the average over a 12-month period, as we touched on. But also you can get an understanding of what's impacting your credit score. So if we scroll down, you can see there's credit risk factors, and you can see what's having a positive, a negative, and a neutral impact. And you can expand on each of those in more depth as well. A second thing is that you can also credit check other companies, the businesses that you work with. You can search for them here and you can see whether they're high risk, emerging risk, or low risk. You can see their credit score, whether they typically pay late on average, their probability of default. So you can actually decide whether you want to minimize or increase your exposure to these sorts of businesses, or even if you're being super proactive, you can do this before working with a potential supplier. You can boost your credit score. So going back onto the credit profile here, you can look at the credit review service, so this blue box here, which we'll touch on, about how Experian can professionally review and manually review your credit score. And then you can look for funding as well. So you can access a panel of over 130 lenders so that we can match you to the most appropriate product and lender to suit your business needs. So yeah, it's really 4 key areas, but all based around exclusive Experian data.
Great. So if a business wanted to improve their credit score, what can they do about it? What actions can they take? Yeah,
so I guess a couple of tips, just generally speaking, is keeping business information up to date. So on Companies House and filing consistently. Something that Experian will always look at is whether the accounts were filed the same as the previous year, and there's that pattern of consistency. Obviously, paying bills on time is really important, and using business credit responsibly. So not taking more debt than you can afford. As we've discussed here, using tools to actually proactively track your credit score and those are the businesses that you work with as well is going to be really key. So, for example, using something like Capitalise for Business through the partnership that we have with PM+M, you can easily track your score and those are the businesses that you work with. But also a quick and effective solution as well is, as I touched on, the credit review service, because it instructs Experian to take additional pieces of information into account over and above what's actually publicly available. So they can manually, basically like underwriting a loan, they can manually assess your credit score by looking at additional bits of information and your associated recommended credit limit for suppliers to assess whether it's accurate. And actually, a shocking fact is that 96% of businesses don't have an accurate credit score. So it could be boosted by providing more up-to-date financials to Experian.
So if we had a business and they already had a really high credit score, they're already classed as an A rating, is there something that they need to look at, or is it just kind of leave it as it is?
Yeah, that's an interesting question, actually, because I guess if you've got an A credit score, it's quite likely that you think, brilliant, I can get all of those benefits of cheaper funding, better supplier credit, and I'm likely to win new work when tendering. But the reality is there is still actually more that you can do, even just moving higher up into that A banding. It's between 90 and 100. If you can get as close to the 100 as possible, then with that, you're actually protecting your credit risk and maintaining as high a score as possible. But not just the credit score, the credit limit is really, really important. So you might have an A credit score, but your limit might not be as high as you would like it to be. So to give you an example, there was actually a recent business that we work with in the hospitality sector, but they did have an A rating. It was actually a score of 100 out of 100. So typically you would think, look, there's not much you can do, but their credit limit was 380K. Again, quite a good amount, but there was more that we could do. So through the credit review, the limit actually increased to 1.2 million, which enabled that client to access more than 3 times the supplier credit from each of their trading partners. So really a life-changing improvement for their business in terms of those suppliers that they work with.
Yeah. And in terms of like interest rates, what's the difference in the rates? So if you was, say, an A credit business compared to a B or a C credit rated business? Yeah,
that's a good question, and it's quite difficult to accurately answer because a credit score is just one element that makes up the interest rate that you're offered. But typically what we're seeing in the market at the moment for your standard unsecured working capital loans is typically 8% per annum is considered good for an A credit client. So sort of if you're in that B band and it's looking more like 10, 11%. And most borrowers who've got an average credit score sort of leaning towards suboptimal, it's between 12 and 16%. We did see as high as 22% for a D-rated client recently. So yeah, it really is a key factor to bear in mind.
Yeah. So you touched on when we were looking at this on your platform about looking at the credit scores of other companies and monitoring people who you're looking to work with, or people who you're looking to supply your services to. Why is that kind of important to monitor? What does that give you?
I'll go back to it here so you can see I'm just on this page of the credit check in other companies. So understanding the credit risk of potential partners or customers, it really allows a business to make informed decisions about engaging with them in terms of business relationships. So for businesses that offer trade credit to their customers, monitoring the credit score of the businesses that they work with is going to help mitigate the risk of late or non-payments and bad debts. So if you think about at the very start when I set the scene with the economic landscape, the hours that are actually lost chasing late payments and bad debts, you can actually get that time back by being proactive with credit checking other companies. And also businesses that are in the A banding, to actually get into that A banding, you're 6 times more likely if you are credit checking other companies. So it's not just your own credit score. If you're a B2B business in particular, it is really, really important. Actually, I'm going to go back to the slide so I can show you an example of this in practice as well. Let's share this again. So hopefully you can all see that okay, but this is really an example of the cash flow cycle. And if you think about you're a business and you've just won a major contract, let's say with somebody like Tesco's, initially you're going to think, this is amazing. This is a great opportunity for my business. And, how great that we won this contract. But typically what most businesses will do in this scenario is that they won't actually credit check that particular company. So what they won't be aware of is that on average, Tesco take 200 days to pay. So in that scenario, the business isn't forecasting costs. They don't realize that at some point there could be a cash shortfall because of those late payments from Tesco's. And the reality is that they don't get paid on time, and they might then need money for payroll or for other business activities. So they then go to look for funding. And as I said, it's triggered by a particular need. And in this case, let's say they need money for payroll, they look for funding, and because they're not being proactive, they realize, actually, I've been declined for funding because of my affordability, because of my low credit score. Let's say you've got a D credit score, which is suboptimal. And actually, that's what we see so often in terms of the cash flow cycle. But what we should think about is, how can we break this cycle? So let's say at the very start, before you actually win the contract, you're checking their credit score and their credit risk. So you're aware that they take 200 days to pay. So you can put the necessary provisions in place. Also, if you're on top of your credit score 6 to 12 months before you need the funding, then when you do then have any cash shortfalls, you're in the strongest position possible to access the funding that you need. So it's all about thinking at each stage of this cycle, how you can slightly change the narrative and the behaviours that you adopt to ensure that your business is thriving and that you're building resilience. So yeah, really important to stay on top of credit checking other companies.
Yeah, thanks. And if a client is already doing that, so you can use Capitalise and just use a credit every time that you want to check a business. Why is that different to the platform that you've got?
Yeah, good question. So I think the first thing to probably mention is that, as I said at the start, Experian is the prime reference agency in the UK. So it is what most lenders and suppliers rely upon in terms of the data that they use. But let's say, in particular, your supplier did use one of the other bureaus like CreditSafe or Equifax. At Capitalise, we do have a solution where we can improve credit scores across the other bureaus as well. It is just more on a case-by-case basis. But what I would recommend is, if you're already using a credit checking facility like CreditSafe or Experian Direct, and maybe just take a look at that annual subscription that you've got, how much you're paying and what you actually get included for that. For example, the number of credit checks that you can do, whether you get live alerts on that as well, or whether it's more manual, and any additional benefits, and weigh it up with Capitalise Business through having a conversation with your contact at PM+M. And then you can compare and see what the right fit is for you. We have some businesses that use both CreditSafe and Capitalise for Business. We have some who actually, when their subscription renews, they decide to move on to Capitalise for Business because it's more interactive and they can access funding too. But it really is dependent on the business, and it's thinking about what is the best for you.
Okay, great. And key tips. So keeping your credit score as high as you possibly can. What are the key things that everyone should be doing?
Okay, so a couple of key practical tips. Definitely keep business information up to date. As we touched on, proactively track your credit score and really understand those factors that are impacting your score. It'd be different for every business. So what's having a negative impact on your business credit score, and how can you go about changing that? Proactively track the credit scores of other businesses that you work with. Monitor public records, use business credit responsibly, pay bills on time. So the standard things there, but also, what you're filing at Companies House, ensure that it's on time, in line with guidelines, and also that you're filing full accounts to provide more data about the financial health of your business. But probably the key takeaway, I think, from the webinar today is really plan ahead and be proactive, and invest your time in tools that can help you do this, that won't take too much of the day-to-day, but will have massive benefits for you and your business.
Wonderful. Okay, We're just going to open up for some live questions. Jordan's messaged in the chat. Just a question, like how adversely would a CCJ affect a business credit score? Like, would it take it down from a band A to a band D, or does it depend on the CCJ, or is it just that there's a CCJ?
Yeah, that's a really good question, actually. I think, to be honest, most of the CCJs that we see with a business, they typically have an F credit score. So it does have a really big impact, but that's if it hasn't been settled within 30 days. So I think the key thing is make sure that, with tools like this, for example, you're alerted every time a CCJ is registered. So if you can respond as soon as possible, then it will have a much less impact on your credit score, because it doesn't stay on your record. But as I mentioned before, over 30 days, it does stay on file for up to 6 years. So it will continue to really negatively impact your credit score.
So it would take it straight down to an F. That's what you're seeing.
Yeah, exactly. Or at least maybe if it started at an A, it wouldn't go all the way to an F. It depends where that starting position is. Mm-hmm. But typically, we do see an F credit score correlates to a CCJ.
Has anyone else got any other questions for Olivia?
Hi, I've got a couple of questions. Well, thanks first of all for presenting to us and giving us an overview of Capitalise for business. One thing you mentioned, Olivia, was the payment trends affect the credit score. And so does that require suppliers reporting a late payment? And what if a supplier has made a mistake in reporting your business late payment incorrectly?
Yeah, exactly that. So it is the trade creditors that report on a business's payment pattern to Experian. Some larger suppliers, for example, it's a requirement that they report. Some do, some don't, smaller suppliers. But if somebody is reporting on your payment pattern, it's compared to the industry average. So really important to understand what impact that is having. But let's say, as you just touched on, it is in error. Maybe there's a dispute. There is actually a contact number that we can give you at Capitalise, and you can reference Capitalise and call Experian directly. And you can query that, because we're unable to see who has reported that information. But if it is related to a dispute, it's only yourself as the director of the business and Experian who can have that conversation. We can give you the correct number and the reference code to query that.
And my second question was, you mentioned that somebody's able to sort of do the live tracking on various companies. What the number is, the number of credit checks that they're allowed to do on that platform, is that limited, or is there a certain number of checks that you can keep live? Yeah,
so with Capitalise for Business, it's actually two different subscriptions. One is called Pro, one is called Enterprise. With Pro, you can have 10 credit checks. With Enterprise, you can have up to 100. But what these is your list of businesses that you're tracking, where you get ongoing live alerts and updates. Technically, the number of one-off credit checks you can do is unlimited. For example, let's say you have Capitalise for Business Pro, where you have 10 clients you can track and monitor. You might want 9 regular businesses that you want live alerts on. You might want to keep that 10th one just for ad hoc credit checks. But also you can swap and change who you're tracking. So maybe one month you might have a certain 10, and the next month you might want to change those. So either 10 or 100, depending on whether you're on Pro or Enterprise.
So thank you.
Thank you.
Okay, is there anyone else that has a question?
I ask, when the components of determining the credit score, so it's kind of a huge mix of things that'll impact it, is there kind of any one that really stands out as having a very big impact on it? I'm just thinking, I'm seeing quite a lot of people that have noticed a real dip in credit scores if they've kind of taken an extra 3 months to file accounts and things like that. It's been really negatively affected? Is kind of there one that outweighs others, or is it just a combination?
Yeah, that's a really good question. So there is different weighting on different factors. So what we've actually done on Capitalise for Business is we've highlighted the 5 main ones that will impact a credit score. There's over 90 different factors that impact a credit score. But if you can see, for example, as you mentioned, annual accounts being filed is one of the key ones, but also the data that's in there. So as I mentioned, like higher liabilities and assets, more debt than equity, things like that will have a big impact. CCJ is a really big one as well. And also credit and business borrowing. So typically how you've made repayments in the past. That's a really, really big one as well. So with using a tool like Capitalise for Business, you'll be able to see those main ones, and that will show you either positive, negative, or neutral. And so you can at least keep on top of the main ones that are impacting your credit score. But I wouldn't say there's one in particular that is much more significant than the others.
Sorry, just on the back of that, we've mentioned the sort of the year-end accounts, but obviously year-end accounts are sort of filed once a year, obviously. But is there something businesses can do, report an improvement in their accounts if the last filed set of accounts was impacting negatively on their credit score?
Yeah, so that's exactly what you're saying there. Lookman really feeds into the credit review service, because let's say on average accounts are filed 7 to 9 months after the year end. That's what the credit bureau is reviewing, so it's always slightly outdated. Plus, they're not seeing full information like the detailed P&L. So what the type of information, just as an example, that you could provide through the credit review service is the full filed accounts, which show the detailed P&L. Management accounts really help to show the trading during that period. Perhaps, the last set of accounts, what did take a bit of a dip in business performance, but now things are back on track and the management accounts show that. That's really helpful. An age debtors report, for example, if you work with big blue chip companies, that can be taken into account. A business plan, if you're a younger business, can help show where you're looking to take the business, because as we talked about earlier, younger businesses are deemed higher risk and there's less information available. So let's say you only have one set of accounts filed at Companies House, and that's even slightly outdated. There's not much the bureau can go off. So yeah, there's definitely information that can be provided. Even if there's like a recent group structure, a restructure, that can be shown as well. And intercompany debt as well can be reviewed on a case-by-case basis.
So is that information provided directly to Experian through Capitalise, or would somebody be able to do that, access that, and give that information directly to Experian?
So this is through the Capitalise for Business portal. There is also the ability to go directly to Experian, but through Capitalise for Business is the cheapest in the market. And another benefit by working with PM+M is that it's also risk-free. So with the credit review service, your score actually can't go down. But let's say it doesn't change, we can actually refund you the cost of that. So it costs £375, a one-off payment, and you get that refunded if your score doesn't change. But if not, it can only go up. And 96% of the time we see a large increase in credit score and a 12 times increase in credit limit as well.
Thank you.
Thank you.
Hi, Olivia.
Yeah.
Sorry, I just wanted to come back to the about the topic of the CCJs. You mentioned that after the 30-day period, if the CCJ is paid off, then it's removed from the registry. Mm-hmm. However, when companies or suppliers or lenders come to looking at the credit score average of a company, will the CCJ still flag up on that 6-month average period, even if it has been paid off in the within the 30-day period?
Yeah, that's a really good question. So it's not going to have a long-term impact if it's settled within the 30 days. But if you look at the average, where you can see at every point during each month that there's a score, it might take a slight dip. But the importance there that I would say is for the following month, ensure that it's getting back on track. So let's say in January, you have a CCJ registered and the score's taken a hit because of that. If you settle it straight away in February, you'll see that it'll increase. But obviously without settling it, that will have a longer impact. It might stay like that rather than going back up.
Right, okay. But so still in the practical terms, though, that dip will affect the opinion of the lender or supplier in terms of the business relationship with that company, even if it was paid off in the 30-day period.
Yeah, a lender will still look at the time that it took to be satisfied. So if you've got a CCJ on record, let's say for 6 months, a lender will see that, and that's going to impact the ability for them to lend. But if they can see that it's just been registered and satisfied, they can overlook that, and it doesn't mean that funding won't be available. There will be options available.
That's helpful. Thank you very much.
Okay.
Does anybody else want to ask any questions? No. Okay, well, thank you very much, Olivia. It's really informative. Obviously, it gives us a great insight now into the world of credit scores, and how that impacts on our clients and our businesses, and also the current climate where it is increasingly difficult to get funding at an affordable rate as well. Also, just to summarise, that there are tools and assistance that we partner with Olivia in Capitalise. So if anybody does want to review anything that they're doing with the business credit scores, the partners that look after them within PM+M will be able to assist and talk them through the different options that they have. I think the key thing for me that's come out of this is don't leave it too late, plan ahead, keep on top of it, and just be aware of what's going on. I thought it was important what you said about the tracking the customers that you're working with. Like, so a lot of businesses are winning contracts and over the moon that they've won a huge contract for the business, but again, say having a contract that says they're going to pay within 30 days and the reality of them taking 200 days is a huge consideration in what they're doing. So that was interesting, and a great point. Just to summarize, that we do have some of these licenses available that we've already bought so that we can offer them to anyone that wants to try it, and we've got a 2-week free trial on it. The credit review service, Olivia, you said it's £375, but it's refundable because we partner with you. So that's an offer that Capitalise are giving to us for our clients. And there's 2 different types of bundles, isn't there, for the credit checking? So there's an enterprise and pro range. So there's 10 tracking 10 businesses and then tracking 100 businesses. And that's £24 or £59. But if there is anyone that is looking for a free trial, or you have businesses or clients that are looking for that, then do just touch base with us, and we'll put you in touch with someone who can talk to you about it. That's everything. Is there anything that you wanted to finish with, Olivia? Have I covered everything?
I think and just thank you for having me on, and hopefully that was insightful for you all, and happy to take any questions via email as well if anyone does have anything that they haven't been able to ask today.
Yeah, brilliant. Okay, thank you very much for coming.